we've covered many times, inflation and consumer sentiment are tied at the hips. Well, as inflation has come down, this is the core PCE, the Fed's favorite indicator, was up only 0.1% month on month and 4.6% year on year versus the previous print of 4.8%. And sure enough, consumer sentiment has bottomed from 51. It's now at 58. So we're back on the way up. The Fed was among the first to aggressively tighten. They'll be the first to slow the pace and pivot. As we saw in Salesforce and other earnings guidance, the strong U.S. dollar from tight policy has started to weigh on earnings, also on emerging markets. The dollar will weaken when the Fed changes pace, which could be as early as this month. Fed President Esther George said lags from policy are long and variable. Harker said that 86 hikes since 1983, 75 of them were under 50 basis points, and 75 basis points is unusual. And he says 50 basis points is still substantial. So the implication is they want to see the lagged effect of recent 75 basis point hikes before going too aggressively on more 75 basis points or too fast of a quantitative tightening schedule. The jobs report and CPI, PPI numbers in September are more important than Jackson Hole. It's natural to have consolidation off a huge move of June lows that caught managers off sides.